Hello, folks. Welcome back to Management 5804, Leadership and Technology-Based Organizations. I'm Dr. David Townsend, and this is a special discussion of Simulation 1. So we'll go for a few minutes here and discuss the overall simulation scenario, discuss kind of overall class results, and some key takeaways from this particular activity in the course. Then we'll take a couple minutes and basically look through one of the winning strategies. So you got to get a sense of different decisions people made and how it yielded various outcomes for students in the class. So again, the industry that we focused on for this particular sim is consumer products, right? And so you can kind of think about everyday products that we buy in stores. I mean, clearly given the competitiveness and the scale at which companies have to operate, it's a very data-intensive industry. And so companies are investing a tremendous amount in analytics and other decision tools in order to help them manage the sheer complexity of delivering their product to millions of customers on a daily basis. And so, again, in certain types of products, then in many cases, a lot of the data come from barcode scanners or other devices within supermarkets or other types of retail stores. And this becomes critical in order to see kind of how quickly products are moving off the shelf. And so the analytics help executives make decisions, right? I mean, just given the sheer number of products that some companies are selling. I mean, you imagine the number of boxes of Cheerios that are sold on supermarket shelves on a daily basis, right? Just millions of boxes. The need to kind of understand different trends, whether the company is targeting the right customers, different strategies they may pursue, and operational decisions. What are the impact of different maybe production decisions or even the delivery systems of how quickly they can get products to the shelf. And then certainly to figure out whether or not any of the brand awareness or marketing campaigns are working. And certainly in the retail environment or in supermarkets where there's an established product category and established products, companies go through all sorts of promotional efforts to try to increase sales over periods of time. And so you can think about kind of special campaigns that Coca-Cola or the Pepsi Group or others may launch in order just to increase sales over particular seasons. And so again, it's one of those industries where the product itself may be low tech, but the role of technology and analytics is becoming crucially important in helping executives make more effective decisions. And so your particular scenario was to manage the blue product at Kelsey White, right? And so this is a laundry detergent. It's a key product for the company. There's different formulations. There's different ways that you can set the product up. And the challenge is that you've got different customer demand for the different types. So you've got pods, but then liquid may be too difficult for some customers, right? So even though you may in your personal life use pods or you may use liquid detergent, for some customers it may be too innovative, quote unquote. And certainly that's important for you as a brand manager to kind of think through, again, beyond your own experience to understand what specifically the different segments of customers want. And one of the other challenges is the average age of your customers is increasing, right? So that has some implications for the types of demand for products that you could offer. And so as a result, there's kind of this downward drift of the company's market share and profitability. And so the company's behind, right? The use of data and analytics. So part of your goal is to with the new CEO is to kind of bring some analytics to bear on making more data-driven decisions for the company, right? So how do you best position your product? How do you price it? What kind of distribution strategies ultimately do you set up, right? So what's the underlying logic of how you're going to approach the market and try to increase the just the profitability of your company? So within that, right, the game really pushes on two of three different types of analytics. And so one of them is just pure descriptive analytics. And this is oftentimes just kind of an evaluation of what's happened in the past, right? So it's describing, with sets of data, what the particular patterns have been for different companies, right? So what's happened? What are the underlying trends and outcomes that have been experienced? And so again, it gives us an historical snapshot. And this is important because most financial statements, as they're reported, again, like an income statement or statement of cash flows or a balance sheet, if they're done annually or quarterly, they're always looking back. Now they can do pro forma, they can do financial statements to look ahead where there's some forecasting You'll see that happen with companies that provide earnings guidance or some kind of guidance on overall expected future financial performance. But a lot of the companies are becoming less and less focused on that type of work and really just reporting kind of historical patterns. And that's critical because, again, there's so much other decision making that's happening with investors that if your guidance is wrong, or everybody collectively thinks you're going to perform at a particular level, you can see major hits. And in the stock market, your stock price can tank if you miss earnings, even though your company may have done extremely well. It just may not have done as well as everybody anticipated. So, descriptive analytics are important, and they provide, again, a kind of a deep dive into critical aspects of your past performance, and it's critical for companies to understand kind of how they arrived at the present, right? What are the particular decisions or particular issues that have arisen? And the second one is predictive analytics, right? And so predictive analytics is going to use that past data to draw inferences about the future, right? And so a lot of statistical modeling, as you kind of build you could build like a regression model, and you're, simply just taking into account multiple different variables and looking to see what kind of impact those variables might have on, maybe if you're trying to, predict kind of unit sales or market share or whatever. You can look at the impact of different facets of, of how strongly linked different decisions or different aspects of a product may be. And so a lot of analytics tools, again, use sophisticated regression type models or other types of forecasting models to take data, to take specific sets of variables and then forecast, right? To think about, through inference, what's going to happen in the future. And so this is important, and it's a critical way for us to use data to make decisions, because now we're trying to estimate, based on these models we've collected from past data, what's going to happen in the future. And so the forecasting exercise in the SIM was an example of that type of predictive analytics. The third type is prescriptive, right? And so this is really the role that AI is starting to play. And so AI, again, these kind of deep learning algorithms provide a underlying sort of a way to disentangle the underlying complexity of data within a particular environment. And so, again, you could use deep learning, you could extract out all sorts of patterns out of information that may be too complex for humans to potentially design a model to do. Some of the reinforcement learning models, or these, we talked a little bit about these generative adversarial networks, right? So the generative part are genetic algorithms that are producing variation, there to discover some of these patterns, and you're clashing it with that adversarial part. You're clashing it with some kind of a discriminant function. These tools broadly allow companies to discover patterns to kind of get a sense of what could be optimal given a particular set of criteria, right? So you're extracting out of this massive complexity, out of potentially millions of data points, what the best strategies may be. So there's no prescriptive analytics in the simulation. But again, this is really where AI is going. But as you can see, the first two, descriptive and predictive, are challenging enough to manage before we even get to prescriptive, right? Where you're having now algorithms make recommendations to you, and sometimes even the automation of these prescriptive analytics then is machines or software systems are making decisions autonomously without the intervention of humans. So again, this is kind of the third frontier, and it's a challenge going to be a challenge for companies to manage. But your task, again, was just managing the first two. And as you can see, right, there's kind of multiple competitor brands out on the market, and and some of them are doing much better than the blue brand. And so you've got to figure out how to turn things around. And so Turbo and Fresh are the top two products in the market, and you're running kind of in third place. And so you got to figure out, you don't want to be stuck in the middle. What do we do to turn things around? And so overall, you guys did a nice job. And so if you look at the cumulative profit, again, I know a lot of you played the game many, many times just to experiment with different facets of it, and that's great. So when we kind of look at the overall performance here, we've got some, again, some of these really negative numbers here. Were more people that actually performed quite well in certain games that were just experimenting. But you can see for the majority of you made somewhere between, about 180. And the 305, I'm not sure why the data didn't load properly, but it's actually about 337 is the top number there for cumulative profit. But you can see the vast majority of people were in that range, right? So slightly over 50% of the runs, resulted in and that it's a solid performance in the game. And then you have slightly under 30%. We're about 52 million to 178 million. And then clearly see a smaller number that were negative 76 million to about 51 million, right? So kind of right around zero in terms of profitability. But again, almost there's slightly more than 80% of the runs yielded a pretty healthy amount of profit. And so I think the overall range of the best runs for people were about negative 7 million to, again, about negative or positive 337 million. And so negative 52 million. So I've taken the usernames off, right? I don't want to call anybody out. Again, because some of the bottom ones in particular, not these, but others were people that were experimenting, actually did quite well overall, that were just experimenting with different strategies. But again, you can kind of see, some of the performance. And there's some pretty tight clustering actually at the top in terms of cumulative profit. Revenue, again, you see a bit more, just a few, so about 9% of runs yielded over 2.6 billion in revenue. But again, about half of the runs yielded about 1.75 to 2, and then you've got 30% or so that were about 1.5 billion to 1.75 billion. So again, the vast majority of runs yielded a pretty significant amount of revenue for the company. And again, market share, you see just most of the market share was kind of between 10 and 17%, but a couple of you were able to get to 35 to 42%. But one of the things we'll see is that actually to achieve really high market share like that actually created some challenges for the company in terms of overall profitability. And so those two things aren't necessarily in many ways correlated very well, right? And so profitability and market share oftentimes can be inversely correlated in certain product classes, right? And the intuition behind it, of course, is quite simple, because if you lower price significantly to try to drive up market share, that's going to drive down profitability. And the complexity of these decisions, again, when you're thinking about how many boxes of cereal that you may be selling, if you're really a brand manager, you might have just one brand to focus on in one of these massively large companies. But if you're working in a particular space where you might have multiple types of the same product, right, the sheer amount of product sales can be unbelievably overwhelming. And so again, the complexity of how you manage all the information to set up the most effective broad set of decisions that are mutually reinforcing is really what drives a lot of decision making towards analytics. So if we kind of think about overall strategy, again, there were some pretty decent strategies that were implemented in the game, but what we'll see is that even the one strategy that yielded the highest amount of cumulative profit actually saw a decline in performance, and so did quite well up front, but then the strategy starts to fall apart. It just fell apart a little bit slower than others, and so again, real challenge to turn Blue's fortunes around. But in that, right, you kind of think about the role of product formulation and product features, the media channel spending and trade channel spending. These variables played a significant role in driving the overall sales. And given that the customer segment that was primarily purchasing Blue was a bit older, right, pods and other things actually could have actually undermined the overall profitability of the company. And so kind of the powder is the kind of dominant platform, and then as that's matched with effective pricing, and then other types of media and trade channel spending, that's important. But a lot of you indicated that you focus on social sentiment, right? So you looked at the underlying Twitter feed across the side. And again, from an intuitive standpoint, that would seem to make a lot of sense because you're getting direct feedback from your customers. But one of the things that's really interesting about the way that they set this game up is that the data that are showing up in social sentiment have zero impact on your overall performance. And so they put some kind of random variation to make it look like potentially that your social sentiment, right? So whether it was really negative or really positive, that was kind of driving some of the overall success. But again, it makes sense because if you're thinking about who your target customer base is with an older customer segment, you've got to take into account that the information you're receiving on the social channels may not be reflective overall of what your customers who are purchasing the product on a daily basis actually think. And so that's one of the kind of clever ways they built that into the game, that your intuition is actually going to clash with the analytics. And so your intuition that social sentiment would matter, and then you're getting all this, pretty strident, could be very negative feedback on the social channels, just represents a small portion of your overall customer base, and in the end was designed not to have any material impact. And so that is one of the real challenges of managing the simulation, is that you've actually got to allow the data to speak, not just specific types of data that you think may work or may matter, right? Or things that you've seen matter in other areas. It's got to be matched directly to the sources of that information. So if you think about your target segment, understanding who they are, what they want, what specifically they're going to do in terms of response is the critical challenge in this game. And so social sentiment was a red herring and had no impact overall on performance. So some key takeaways, right? I mean, data analytics can be really effective ways for decision making, but it's a very complex process, right? And so using these analytics programs, particularly on even just the descriptive or prescriptive side, it's difficult, or predictive side, so descriptive and predictive, those sides, that's difficult even to manage those, right? Because there's just a massive amount of information. And so ensuring that there's a reasonable link between your data sources and then in influencing the outcomes. For those of you who've studied statistics or know statistics, you know that there's a lot of interesting things that are correlated together that have some kind of an underlying mathematical relationship, but there's actually no direct impact between the two. And then, there's other types of analytics, that prescriptive side, and that's where AI is going to start to play a critical role, not part of this game. But again, that gets to be even more tricky because now you've got a software system that could be diving deep and then making recommendations, telling you not just here's what might happen if I extend this trend line out, but what specifically should you do? And so these decision engines going from, spit out some results based on your pre-specified parameters that you set your model up with, to actually doing some underlying analytics on its own and then telling you here's what you're going to do. Or if you've automated, you've given that software system autonomy ostensibly to make the decision. And so that's going to be a really tricky part. And so it requires us to really have kind of deep understanding of what's going on with our competitors and what our customers really want, right? So just because we can use these platforms and just because the platforms provide more and more sophisticated tools doesn't mean we get away from good strategic logic, right? Of understanding what are the key drivers, what are the factors that make the most difference in shaping the performance of my organization. And so you've got to understand what the key variables are in any particular decision situation. And if you reflect back on some of the things that we've read, so far about AI tools in business, right? And you think about some of the insurance companies and some of the other groups, Pfizer, building these data teams where they take people with deep business knowledge and they're pairing them with statisticians and data scientists in order to build the right model, effective decision model for the organization. That becomes critical, right? So the things we're talking about in class, the issues around disruptive innovation, the issues around crossing the chasm, the issues around ecosystem and business model design, right? Good strategic logic doesn't go out the window just because we have analytics tools that we can use to crunch numbers, right? Those things have to be paired together in order to make sure that the data we're using are the ones that are most relevant to the questions at hand. And so within that, right, just the complexity of doing that, AI tools are going to be incredible for helping us make more effective strategic decisions over the long run, particularly as we get to kind of that prescriptive phase of AI, which is really what's rapidly emerging right now. But it still has to be balanced with human decision making. And we'll see that example with a lot of the companies we'll talk about here in the coming weeks.